Welcome to The Explainer. Sometimes a single decision by just one company can send shockwaves through the entire global economy. That's exactly what we're talking about today. It's a story that pulls back the curtain on a hidden weakness in the very system we all rely on. So, this whole story really kicks off with something that just happened, an event that really shook up the financial world. And it all comes down to this one really critical question. Okay, so get this. In 2023, BlackRock, we're talking about an absolute giant in the investment world, had to tell its investors, sorry, you can't have all your money back just yet. Now, that is way more than just a company having a bad day. It's a huge flashing red light, a warning sign of a much, much bigger problem, a global scramble for cash. All right, to really get a grip on how this happened, we've got to meet the main characters in this drama. And I'm talking about hedge funds and the investment bankers who pull the strings. So what exactly is a hedge fund? Well, think of it like this. Your neighborhood bank. That's kind of like a dependable family minivan. It's safe, it's reliable. A hedge fund, on the other hand, is a souped-up Formula One race car. We're talking massive pools of money, super aggressive, really complex strategies, all designed to chase these insane returns. And they do all this in a world with way, way fewer rules. And this chart here really lays it all out. On one side, you've got your traditional bank. Everything is structured, safe, heavily regulated. You know what you're getting with your savings account. But then you look at the hedge fund side. It's the total opposite. It's all about unstructured products, which is just a fancy way of saying they can be incredibly flexible, pivoting on a dime to chase those huge profits. And look, that flexibility, it's their superpower. But as we're about to find out, it's also a huge source of risk for everybody. So where did this whole system even come from? It wasn't born overnight, that's for sure. To really understand its power, we actually have to rewind the clock about 50 years, back to this epic clash of ideas that literally redrew the map of our financial world. Okay, so picture the 1970s. This was a wild time. President Nixon basically says the US dollar isn't tied to gold anymore. Boom. Just like that, the old rulebook for money? Gone. Tossed out the window. And this created a brand new, massive problem. Inflation. How in the world do you keep it under control now? That question sparked a huge, huge debate. And this right here shows you the two sides of that fight. You had Team Keynes saying, easy, central banks just need to raise interest rates. But the risk there was pretty big. It could totally slow down the real economy, jobs and factories. But then you had Team Friedman, the monetarists, and they had a totally different idea. They said, no, don't slow things down. Let the free markets do the work. Let's create this thing called wealth management that lets people earn more than inflation. And guess what? Team Friedman's idea won. Big time. And that victory, it completely opened the floodgates. This was the birth of the hedge fund era. It created this unbelievable machine for generating financial wealth. But, and this is a huge but, it had this massive side effect. It started to create a split, a disconnect between the world of money and the world of, actual stuff, of real economic growth. And when I say the returns were unbelievable, I mean it. Just look at this number, 35% in 1 year. In US dollars, think about that for a second. That's not just good, it's astronomical. It absolutely blows away anything you could ever expect from a normal bank account or even from running most businesses. So this just changed the entire game, right? The incentives for the whole economy shifted. Suddenly, big investors were asking themselves a very logical question. Wait a minute. Why would I go through all the trouble and risk of building a factory, hiring people, actually making things, when I can just put my money in the market and make way more, way faster? And here's the result. This chart says it all. That pool of money managed by what they call non-banking financial institutions, or NFIs, which is basically code for hedge funds, it just exploded. It's now so massive that it completely dwarfs the traditional banking system. It's not even close. And that has totally changed the game for where all the world's capital flows. Which brings us right back to where we started. This whole situation, this giant ocean of money, always on the hunt for the next big return, it's created this kind of global trap. And this is how BlackRock's little problem suddenly becomes every country's problem. So why did BlackRock have to slam on the brakes? It's actually pretty simple. Their biggest clients, we're talking huge pension funds, all of a sudden needed cash. And they needed it now. So they started asking for their money back. And listen, this isn't just a BlackRock thing. It's a symptom. It's a sign that the whole global system is getting really, really thirsty for liquidity, for actual physical cash. Okay, so if you're a fund like BlackRock and your clients want their cash back, what do? You have to sell stuff. You have to sell the assets you own to raise that money. So the next logical question is, what do they own? Well, as you can see here, a huge chunk of their money, over 60%, is parked in what has always been considered the safest place on earth, government bonds, especially U.S. government debt. And this is where it gets really dangerous. It creates this vicious cycle, a kind of doom loop. Let's walk through it. Step 1, a country, say Indonesia, needs money so it issues bonds. Step 2, in a world where everyone's short on cash, who are the only buyers big enough to step up? The hedge funds. Step 3, but the funds have to deliver those high returns to their own investors, right? So they demand really high interest rates from Indonesia. And step 4, this is where the trap springs. The credit rating agencies see this and go, whoa, that's a lot of interest to pay. That's risky. And they threaten a credit downgrade. If that happens, step 5, all future borrowing gets even more expensive for that country. They're trapped. So, wow. In this super high-stakes game, what does this all mean? What are the big takeaways, not just for governments, but for you and me? Well, the takeaways are pretty sobering, to be honest. For governments, the message is loud and clear. You have to be disciplined. The only truly safe path is to borrow less. Trying to rely on this crazy, volatile market is like building your house on an earthquake fault line. And for all of us, for regular citizens, we need to get used to the roller coaster. This high volatility, these wild swings in the markets, this isn't going away. It's the new normal. And the absolute worst-case scenario here, the ultimate risk, is something called fiscal failure. And that's not just some boring economic term. It's real. It's when a government literally runs out of money to pay for the important stuff. We're talking pensions for the elderly, healthcare, roads, you name it. All the essential things that keep a country running. That's how a financial mess becomes a full-blown crisis for everyone. So when you connect all the dots, right? All the way from a debate between economists 50 years ago to BlackRock hitting the brakes and entire countries getting squeezed today, it leaves us with one pretty profound question to think about. In a world that is so desperately scrambling for cash, what is the real price we're all going to have to pay for stability?